The world's central banks are slowly turning against the dollar and the global monetary system as we know it. How are they doing it? With gold. And is de-dollarization going to happen sooner than we all thought? Let's find out. This week, the World Gold Council published the results of its annual central bank gold reserve survey. Here are the headlines. 29% of central banks intend to increase their gold reserves in the next 12 months. This is the highest level the World Gold Council has seen since the survey first began back in 2018. And whilst nearly 1/3 of central banks surveyed will look to buy more gold in 2024, more interestingly is that there is a broad expectation across the central banks that gold reserves will rise. 81% of survey participants, in fact, expect holdings to rise in the next 12 months. Quite the climb up from 71% reported last year. And central banks no longer see gold's historical role as one of the main reasons to hold gold. So why do they hold it then? We'll come to that shortly. So as we know, last year was another cracking year for central bank gold purchases and therefore the gold price. Last year, central banks added 1,037 tons of gold, the second highest annual purchase in history, following a record high of 1,082 tons in 2022. And central banks play a crucial role when it comes to gold price performance. And this is because when central banks hold, buy it and trade it, it cements its role as a global currency. And central banks' activity in the gold market has significantly influenced prices at an increasing pace in the last 2 years. Whilst monetary policy remained tight and ETF outflows were ongoing, the gold price stood its ground. And this was in large part thanks to central banks. This demand has continued into this year as central bank net demand totaled 290 tons in Q1 alone. This is the strongest start to any year on record. Now, much of this came from China, Turkey, and India. And of course, the report that we're talking about comes just a fortnight after it was reported that the People's Bank of China likely didn't increase its gold reserves in May, ending an 18-month buying spree. But no one expects this to mean that this is the end of robust demand from institutions. As the results of the World Gold Council report shows, there is plenty of demand out there to keep central banks as a major buyer of physical gold in the near future. This strong central bank demand is having a major effect on the psyche of gold market observers, and in turn builds on the influence that these institutions are having. Their voracious appetite for gold bullion is making financial market stakeholders really sit up and not only think about gold as a long-term investment for themselves, but also why central banks are stocking up on gold and what this means for the globalized financial system as we currently know it. So why are central banks buying gold? To quote the latest report, the planned purchases are chiefly motivated by a desire to rebalance to a more preferred strategic level of gold holdings, domestic gold production, and financial market concerns, including higher crisis risk and rising inflation. Now, I don't know about you, but I think that's a pretty polite way of saying central banks are scared. Central banks are buying gold for all the right reasons. All the reasons why we sit here week after week and tell you why gold should be in your portfolio. Think about it. The uptick in central bank purchases have come at a time of ongoing geopolitical tensions. We've got the unabating conflict in the Middle East, a prolonged war in Ukraine, heightened tensions across a number of strategic regions, and that's not all. On the macroeconomic front, although official global inflation is beginning to cool, economic recovery remains very uneven across the globe, and concerns about underlying financial vulnerabilities persist. Now, consequently, interest rate levels, inflation concerns, and geopolitical instability continue to be the primary factors that are influencing central bankers' overall reserve management decisions, just as they were last year. But what are the factors that are driving their decision to add gold to those reserves? Well, this is really interesting. If you look at this chart, then you will see that all the reasons why individuals should hold gold are also the reasons why central banks are holding gold. No default risk is the most popular reason, followed by its performance during a crisis, and so on. But this isn't the only part of the story. When compared to last year, those who have the reasons for owning gold because of sanction concerns and de-dollarization policy have increased, i.e. more central bank reserve managers are buying gold because they see the division that is happening in the global monetary system and they understand that gold is going to help to protect them. So are we talking about de-dollarization picking up pace here? Well, we've posited for some time now that we expect to see marginal rather than rapid de-dollarization. Right now, the global system is dollar-centric, but that doesn't mean that this won't change. and it can't just change overnight. This is something that an increasing number of central banks agree with. And continuing a trend seen in last year's survey, the outlook for the US dollar's future share of total central bank reserve assets has further declined. And right now, 62% of respondents believe the dollar's share will decrease over the next 5 years. And this is an increase from 55% in 2023 and 42% in the year before. But here's another thing that's interesting, although not so surprising. There's another area where we are seeing a gulf between central banks in advanced economies and those in emerging market and developing economies, EMDEs. Whilst 30% of respondents from advanced economies believe the US dollar's share of global reserves will remain unchanged 5 years from now, only 11% of those in EMDE countries agree. And more notably, the percentage of advanced economy respondents who think the US dollar's share of global reserves will decline has risen from 46% in 2023 to 56% this year, indicating growing pessimism about the dollar's future share, even among advanced economy respondents. But the trend does suggest that the West is coming around very slowly to everyone else's way of thinking. EMDE central banks, which have been the primary drivers of gold purchases since the 2008 global financial crisis, appear to be more pessimistic about the US dollar's future share of global reserves, but more optimistic about gold. So take a look at this chart that shows what proportion of total reserves, Forex and gold, central banks think will be denominated in gold 5 years from now. You can see that it is notable that the percentage of advanced economy respondents who share the same views as the EMDE central bank has increased by quite some margin, from 38% last year to 57% in 2024. So whilst we can get excited about how much gold central banks are buying, it only really matters when you look at it relative to what else they're doing. In short, it shows that they're re-strategizing. They're stepping away from what has become the norm of trust the US dollar. What this survey shows is the growing role or the growing importance of gold in global reserves, and that this is an ongoing trend observed in previous surveys. Whilst EMDE central banks remain more optimistic about gold's future share of global reserves and more pessimistic about the US dollar's future share, there is a notable shift among advanced economy central banks towards the same perspective. And this role of gold is really, really important to understand. After all, it's not at all unusual for central banks to have always held gold. Central banks own gold would never have made a decent headline. But what is headline making is why they are increasing their reserves at the rate they are, why they are doing it now, and why are they doing it when the price is climbing. What is so joyous and interesting about these results is that it's real demand. This is in no way speculative. It is strategic. It is not as though an individual at the bank call up on a whim a broker for a few good delivery bars. No, imagine the hoops that central banks will have had to go through in order to agree to these purchases, the justification for it, the meetings that were held, the charts that were run, the analysis that was worked, all to determine whether or not it was in the central bank's, no, the country's best interest. And if you're wondering if gold is in your best interest for your portfolio, then why not check out one of these videos now?